The topic of the lecture, Policy Insights from a Tax System Perspective, is one of which Professor Slemrod is a renowned expert as an academic with a long and impressive list of publications and experience. However, Professor Slemrod is also an active practitioner, having acted as a consultant to countries and international institutions all over the world.
Professor Slemrod's work covers almost all aspects of tax policy and does it in a very thoughtful and rigorous way, addressing at the same time relevant policy questions. One of the areas where Professor Slemrod has made major contributions is in tax evasion and in tax compliance, both at individual and corporate level.
Our tax system is a set of rules, regulations, and procedures that do three things. One, it defines what events or states of the world trigger tax liability. A tax system also specifies who or what entity must remit that tax and when. And the third thing a tax system does is it has to detail procedures for ensuring compliance with the tax rules, including information reporting requirements and the consequences of not remitting legal liability. So I call those enforcement rules. And the standard analysis presumes that tax liability can be ascertained by the government costlessly and collected costlessly, in which case the second statement here is irrelevant, and the third statement is unnecessary. If everybody pays what they owe, then certainly we don't have to worry about enforcement rules. But I think we could all agree that just thinking about one without two or three is not addressing the world that we live in. So there are multiple costs with taxation. I mentioned administrative costs, I mentioned compliance costs, but in graduate school in economics, we spend most of our time thinking about a third cost I didn't put on the slides because it's the standard toolkit, but I should mention it, and that is the costs of taxation that come because people change their behavior and businesses change their behavior when we put on taxes. When we tax labor income, people might work less. When we tax the return to savings, they might save less. When we tax the return to investment, businesses might invest less. Those are all costs of raising taxes. So that's in the standard toolkit. So what I want to talk about today is adding to the standard toolkit some other kinds of behavioral response. So I mentioned Agnar Sandmo and his co-author had the first positive analysis of tax evasions. And so now we have a model of tax evasion which says whether I evade and how much I evade depends on how risk averse I am, what the chances are I'll get away with tax evasion are, and what happens if I get caught. An optimal tax systems approach changes the answers to classic optimal tax questions, like how progressive should the tax system be, but it raises new questions that we couldn't answer before. How much resources should a country devote to enforcing its tax system? What's an optimal auditing structure? How do you collect information? How do you involve firms? If higher tax rates on the rich would induce taxable income to move offshore, does that mean we should abandon the attempt to increase top tax rates? Or does that mean we should crack down on the flight of capital? Or a little of both? This is the kind of question which I think is central to the tax policy of many countries that we can talk about with optimal tax systems. I'm totally convinced we have to expand how we do taxation to include these phenomena. And the formulas and the standard tax analysis is far from the reality of the world that we face. And we need to expand our analysis to these issues that are prominent in the formulation and implementation of all countries' tax policies. Thank you.